All right, everyone. Welcome back to today's third live streaming session. Before we start the session, I just want to make sure that people can see me. I hope everyone is, listening to me. I hope my voice is audible. All right. I think we are good to go. All right. Very, very, very good evening to each and every one of you who is attending today's third live streaming session, right? Today being the 20th of November, being Wednesday, correct? The midpoint of the week. Since today morning, the stock market has been closed because of the state assembly elections that are currently happening in Maharashtra. And since the Bombay Stock Exchange is located in Mumbai, the financial capital of India, the stock market for today has been closed, right? And since morning, we have been utilizing today's uh, time and been, using it as an opportunity in terms of talking more about technical analysis. All right, so let me start today's third live streaming session with a quick introduction about the one and only Harsh, right? I am Harsh. I have 8 years of trading experience. I have been trading the forex markets. I have been trading the commodity markets like oil, gold, silver, as well as the US indices such as S&P 500, the Dow Jones 30, and the Nasdaq 100. I am more of a technical trader. I specialize in technical analysis, right? Such as supply and demand, price action, order flow analysis, swing analysis, wave analysis, as well as Fibonacci retracement analysis. When it comes to technical analysis, it is quite expansive. It is quite diversified, but these are the major categories that I have been focusing on. I have been blessed to be trained, to be guided by some of the brightest minds in the financial markets. I have, I have had the opportunity, the privilege to be trained by people who used to trade on the floor of the Chicago Mercantile Exchange, right? So we are talking about those traders who used to physically trade. We call them as floor traders. And it has been such a boon, such a blessing for me because I have learned a lot, when it comes to technical analysis, when it comes to financial trading, when it comes to the financial markets. I have been successful in handling $20 million worth of portfolio. And on top of that, I have been also consistent in generating around 30 to 35% of profitability on an annual basis. The reason we are showcasing our credibilities, our qualifications, so that you can be rest assured that the information that you are receiving is being provided by someone who has knowledge, who has the experience, and who has the expertise when it comes to the financial markets. So that has been a quick introduction about me. Now, here at Dolphin Markets, our main goal is to provide you with valuable content, right? Content in terms of analysis, content in terms of trading opportunities, right? We call them as hot stock recommendations, money making strategies, and we also provide you with education. So we are providing you a trifactor bonanza of vital content, right? Content that is vital and very lucrative in terms of its value. Let me ask everyone a question that I keep asking because it is so important to understand. Many people in the markets are, still not clear in terms of how the stock market performs and is there a potential to make money. So let me ask the question: do you think it is possible to make money in the financial markets? If you think it is possible to make money in the financial markets, you can type one in the comment box or you can type yes. If you think it is not possible to make money in the financial markets, you can type two or you can write no. But I'm pretty sure majority of you are aware that yes, it is possible to make money in the financial markets, but maybe you might not be having the right tools, the right information, the right mentor to guide you, through the financial markets, and or might have taken severe losses in the past, right, in the financial markets. So that is completely understandable, but also to showcase you that we at Dolphin Markets have been providing you with consistent trading opportunities and consistent profitability targets, right? We have been informing all the way from 18th of September till 14th of November, right? 14th being last week's Thursday. So these, the data that you can see on the screen are based on us providing you with real-time trading strategies and also showcasing how much we have been able to capitalize in terms of profitability, right? We have been letting you know in terms of the date, the name of the name of the stock that we have been providing, the time at which it was open, the direction, the entry point, and once the trade has been triggered and is approaching closer to target, we have even informed you the closing date in terms of when the trade had achieved its target, the price at which the trade was closed, and the profitability, right? The profit value that had been generated in percentages, right? So this has been phenomenal for us. We have been able to provide you with consistent trading opportunities and consistent profit booking, right? Because profit booking is equivalent to making money. We have been consistent in making a cumulative profitability of 147%, right? With a sample size of 36 trades. So for those people who think, are we taking trades on one or two or three trades or stocks and making huge returns? No. We believe in taking consistent trading opportunities based on the market conditions and letting you know as and how the targets are coming closer, right? The moment price achieves the target profit, we inform you in terms of closing, right? And over a span of 2 months. So 147% profitability in 2 months is no joke, right? It is commendable, it is fabulous, it is fantastic, right? When it comes to such kind of returns, we have been also providing you with a detailed and descriptive record in terms of the variables that are required when a particular hot stock is identified by us and is shared to you. So we image once a hot stock is immediately identified, we let you know in terms of the date at which it is currently happening, the name of the hot stock, we call them as hot stocks, correct? The entry price as well as the 5% target. For those of you who keep asking, Harsh, why 5% and why not more? Why not 10, 20, 30, 40%? Over the last couple of months, with our thorough analysis and back testing, we have figured out that 5% profitability is the right amount of profitability that can be achieved consistently, correct? So yes, we do provide you with further targets such as price target, first target price as well as second target price, but our main focus lies in the 5% because we want to showcase our beautiful community members that we can take trades and we can close trades on a consistent basis, right? So over the span of 36 trades, over the duration of 2 months, we have been consistently delivering, an average profitability of 5%, and cumulatively we have been sitting at 147. So this is the power that Harsh and Dolphin Markets are providing to you. We want you to utilize this to your benefit, right? Now we have talked enough about our potential and our credibility when it comes to performance and making money in the Indian stock market. But since the Indian stock market is closed, it has been closed since morning. But anyways, the third live session takes place after the general stock market closes, right? So we will be focusing at basically by shifting our focus from the Indian stock market to the forex markets, right? To the international markets. We are talking about forex, we're talking about gold, and we're talking about CFDs, right? Certificate for difference. So let us have a look in terms of, and today is going to be more of an education streaming session, right? Where we would be covering advanced technical analysis, right? So Monday's third live streaming session was covering the basic technical analysis strategies. Yesterday, that was Tuesday, we had covered the mid-level trading strategies pertaining to technical analysis, and today being Wednesday, we will be focusing on advanced technical analysis strategies. All right. So without wasting any further time, let's go and let's have a look at our PowerPoint, right? So let's start with today's main content of this particular live streaming session, and that will be based on advanced technical analysis. All right. Now, you have to understand when it comes to advanced technical analysis, rather than focusing on price and on indicators, we are trying to understand who are the biggest players when it comes to the financial markets, right? And there are only two parties when we talk in terms of big players. Big players, as in people who have the liquidity to move the markets. Please understand the stock market requires a lot of capital for a price to move even by one tick. For example, if the price is at 100 rupees and we want to move the price to 101 rupees, right? So we want to increase the value of a stock by 1 rupee. You need to have a minimum investment of hundreds of crores just to move the price by that one tick, right? So I'm just trying to, make it clear that there is a lot of money involved for even moving price by one tick. So people like you and me are not sufficient in terms of capital to move the market by such values. So who are the major players when it comes to market market or price action is basically the FIIs and the DIIs, correct? So who are the FIIs? FIIs are the foreign investment institutions, and DIIs are the direct domestic institution investors. Now, this is a very quick introduction and a description, sorry, about FII. So, FIIs are investors who are investing in India, but they are not a part of India, right? So, companies which are basically originated from abroad, right? Maybe in countries like US, UK, Australia, such as Apple, Microsoft. So these are companies that have been established abroad, but they are investing in India. So these are examples of FII. You can see other examples as well. We have JP Morgan, Euro Pacific Growth Fund, Morgan Stanley, right? So I'm pretty sure you are aware of these brands, right? JP Morgan and Morgan Stanley are banking institutions based in the United States of America, and they also act as investors, right? Foreign investors investing in the local economy, right? Investing in the Indian share market. At the same time, we have DIIs, right? So DIIs are basically Indian investors who want to profit by putting their money in the Indian stock market. And they can be insurance companies, mutual funds, liquid funds, and other investments as well. Now, when it comes to, and some of the examples of DII are given below, right? We have ICICI Prudential, we have Nippon AMC, we have HDFC Life, right? Now, in terms of a quick contrast, a quick distinguishing factor between the FIIs and the DIIs. First and foremost, definitely the location. FIIs are based abroad, while DIIs are the local investors. When it comes to the limitations of the total amount of investment, the FIIs can only invest up to 24% of the total amount of the company's paid-in capital, while in terms of DII, there is no such restriction. We have research teams, we have stock market holdings. So FIIs hold approximately 21% of overall holdings in the companies that make up the Nifty 500. Nifty 500 is the broader based index, right? Do not get confused between the Nifty 50 and the Nifty 500. They are two separate indices. While on the other hand, DIIs hold about 14%. So based on this value, I'm pretty sure you are clear that in terms of liquidity holding, right, the FIIs are much advanced in terms of, or they have a bigger proportion when it comes to the capital, right, that is being held by the FIIs, right, in companies of that are listed on the Nifty 500. Then investing style, right? So FIIs are basically investing with a focus on short term to medium term gain, right? While domestic institutional investors are mainly looking for the long run. And this is one of the major reasons why during the month of October, especially from the end of September, the last week of September till now, there has been a lot of outflow, right, of FII capital in terms of them pulling out funds from the Indian economy and investing it into economies of other countries such as China and United States of America, where they are getting better returns on their investments. So the reason why FIIs are pulling out funds is not because the economy is, you know, yes, the economy is performing, it's not performing well, but it's not because they do not trust the future prospects of the Indian economy. They are basically trading based on their short to medium term goal, right, of making money on their or in terms of making capital in on their investments. But when it comes to DIIs, they do not think of short to medium term; they think of the long term, correct? Now we are going to come to the main topic, which is included in advanced trading strategies, and that is going to be stop loss hunting. People should be aware that the market is a zero sum game. What comes in goes out. If someone is winning, someone is losing. If someone is losing, someone else is winning. So market is like a valve where prices are being flown in and people are either making or losing. There is no, other direction or other way that people can enter or exit the markets. So with stop loss hunting, what happens is there are certain places on the charts that we will be looking at where people have a majority of a sentiment that prices might perform in a particular direction. So generally the market will, try to take out liquidity. Right now we are entering into advanced technical concepts, so please bear in mind we will be using certain analogies, certain technical terms which might, sound fancy, like SMC, ICT, liquidity, stop hunt, so on and so forth. But anyways, in terms of the basic concept of stop loss hunting, is basically, as you can read in the definition itself, it's a type of trading strategy that aims to profit by deliberately triggering other traders' stop losses. So, where the majority of people are placing their stop losses, there is a general consensus that prices will mostly be, will prick or wick, we call it as wick, or basically stop everyone out before they would continue in the desired direction, right? In terms of how would you identify such kind of stop losses, there are certain points like key tactical levels, right? Attempting to figure out where stop losses may be concentrated based on support and resistance or key chart patterns, right? We will look at it in the charts as well, in terms of order flow, in terms of depth of market, in terms of sentiment and news analysis. So these are some of the major points where, where a majority of people have a biased consensus, maybe in terms of going long or short, and how the markets, right, how the big market players are, are able to stop out people so that, they can take out the majority of players from the market and continue in the required or desired direction. So let us have a quick example in terms of a visual example in terms of what exactly is a stop hunt. As you can see, this is the chart of micro E mini SMP. So do not get confused if I'm showing you an international company, international equity index. It does not make any difference. We are just trying to, understand the phenomenon behind a stop loss hunt, a stop hunt, right? So as you can see, the blue line indicates the price level at 3904.5. The prices had initially acted as a support by going, by respecting the support area and continuing higher. But as the prices retraced back to the level, many of the people who thought that the support should be holding, right? So where there is a general consensus that if prices have done something in the past, they should repeat it in the future as well. So the next time prices came to the same area, prices were manipulated. Prices had gone lower than the support area, only to return back into the desired direction. So such movements are basically called as, you know, manipulation areas or stop loss hunting areas, right? So people are stopped out at these particular areas where people are expecting the prices to continue, or for this particular example, people are expecting that prices should be holding the support, but unfortunately prices are manipulated. The stop losses of majority of the traders at this particular level are hit, and once the stop losses are hit, the prices return back to the normal or to the direction that people were anyways, expecting, but only after they have been stopped out. All right, let's look at another example. This is quite interesting. I'm pretty sure we all are aware by now in terms of what trend lines are, right? Trend lines are lines that are able to connect as many pivot points as possible, right? So with a trend line, the main focus resides in price testing the trend line and reversing, right? The more number of times a trend line is tested, the stronger that particular trend line is considered to be. So as you can see, we have a bearish trend line, which is basically acting as a resistance, and we have a support, right? We have a horizontal trend line which is acting as support. So prices have been oscillating between the trend line. As you can see, prices came and tested the trend line once, twice, almost thrice, but here we had the third touch. Then prices had manipulated. So for people who are, having the general consensus, if a trend line is holding for more than three times, the strength of the trend line increases significantly, right? But in this scenario, once prices reached to the trend line for the third time, where majority of people were expecting prices to hold, the price is manipulated, right? Hitting everyone's stop loss before continuing back, right, in the desired direction. So majority of the people who expected the prices to continue bearish were correct, but because of the manipulation, because of the stop loss hunting, the prices had, exceeded the stop losses of many people by hitting, their stop losses and then reversing in the desired direction. So the general consensus were correct in terms of direction. There was an expectation for a bearish movement to take place, but because of the manipulation, majority of them were stopped out, and then prices returned. So point pivot number 4, pivot number 5, and pivot number 7. These are clear examples where markets are manipulated, right? But they continue in the desired direction that people had expected. Since market is a zero sum game, someone is winning, someone is losing. If someone is losing, someone else is winning as well. So we should be aware that such factors exist in the market. Please bear in mind the markets are based on probabilities. The markets are not based on certainties, right? So if someone out there is telling that all the trades that I take are winning, for that person, they might be not saying the correct information, right? Everyone will be making and everyone loses at some point in time, right? But we just have to make sure that we are making cumulatively much more than what we are losing, and that is how we are able to stay net positive, right? It's always based on the net result, right? Not based on one or two trades. It is based on a consistent number of trades, and with the majority of trades hitting profit, that showcases the power of your trading potential. Not that all the trades you're taking are hitting profit, right? Because if that was the case, there is no one on planet earth who is able to take trades and all the trades are hitting, profitability values. But nonetheless, if you have majority of your trades that are hitting targets, that is a good job. So this is a very typical example, as you can see on the screen, where we had the manipulation taking place, not once, not twice, but thrice, right? So the markets will do what they have to do. The markets run on probabilities and not certainties. All right, now let's go to the market manipulation. One is where prices are manipulated at a particular key point, key pivot areas, so that many of them are stopped out and then prices return. So this is a concept or a phenomenon where stop losses are triggered. That's why we call them as stop loss hunting, right? Now the other concept that we would be talking is market manipulation, though the context remains the same but the structure changes, all right? So what is market manipulation? It is the attempt to artificially increase or decrease the price of a security, right? It is artificial because the manipulator is attempting to skew. The meaning of skew is distort, right? Supply and demand to push the price in a favorable direction for them. So let us look at this typical example, and this is based on a real chart, right? As you can see, it is based on the Aussie dollar against the Swiss franc, right? On the 1 hour chart. So these are real market examples, right? And these are very good examples to learn from. All right. So in terms of this particular, concept, let us try to understand. So we have a resistance in place. As you can see, the red color box. The prices had approached the resistance area, and they were, pushed in a bearish fashion. The next time prices came back to the same resistance area, based on the general consensus, people would be expecting to have a repetition of what had happened in the past, correct? So people would be expecting that yes, the moment prices come back to resistance, prices would be pushed lower again. The prices did start initially with having a bearish sentiment, but as you can see, they started to consolidate sideways, and they started to show bullish pressure coming up again. So at this point in time, you can read that sellers place their short orders here. So here and here is where people are like, okay, now the resistance is holding, it is a good time to take a short, right? What happens? The price goes closes and continues much above the resistance, right, creating panic. So now you can see sellers close positions in loss, and I'm pretty sure that people are aware there are two types of traders. Some are based on support and resistance, where prices either approach the resistance or the support, and people want to take the reversal trades. We have another category of people, of traders, who are called as breakout traders. Now, if a resistance is taken out by a price, people are expecting that now the resistance is over and prices should continue higher. Similarly, we have based on support. If the support gets taken out, the breakout traders believe that now the support is finished and the prices will keep continuing lower. All right. So based on that concept, we had the sellers who had taken the trade based on resistance at this particular area, the red color box. But because the prices had closed above, they were in panic mode and they started to close their trades. At the same time, we had a lot of breakout traders jumping onto the trade because they saw that now the resistance is over, the prices should be continuing in an upward fashion. To both their surprise, right? To both the people, to their surprise, we could see that prices started to reverse again. So now the people who had taken short at resistance, they had panicked and they had closed, and there were people who had taken trades on the breakout. Now that the prices are reversing, this is a typical manipulation where prices should have continued, but because of manipulation, the people who had got stopped out and the people who had entered based on breakout, both of them suffered, right? So with the breakout traders who had entered, the moment prices had closed above resistance, now they start to panic and they start to close their trades, right? And this is what a typical manipulation looks like, correct? Let us look at another example and then we will look at the charts as well, correct? In terms of the next example, as you can see, we have an area of resistance again, and with the candle closing above, right? So people are expecting that now, but there were people who were taking shots on the resistance, but now that prices are closing above, people are like, okay, now it's a breakout trade, right? We did talk about breakout trading in our um, on Monday's third live streaming sessions. For those of you who have missed it, You can go and check the previous recordings. So based on the breakout trade, as you can see, the prices close outside. Now people who had taken shots based on resistance are panicking. They are closing their trades, and people who think now that the prices have closed above, now the prices should continue, right? We are talking about breakout traders, and then you can see that the prices start to consolidate again. So the people who got stopped out based on the shorts, based on the resistance holding, they were, they are angry, and the people who are taken longs, right, based on the breakout, now they are also panicking, right? They are angry and they are panicking as well. So this is basically called as a manipulation. Now the market is starting to range, sideways, and now people are expecting, now that the prices are again creating a breakout to the downside, we should be looking for, maybe a continuation to the up. But now the market manipulates again, and there is a strong green candle followed by a strong red candle. So now this, people are left in astonishment, like what is happening. We expected prices to hold, but there was manipulation around key areas. Remember, market manipulation cannot happen anytime and every time. Market manipulations happen at certain key levels where there is a larger consensus for a particular mindset in terms of people going long, people going short. And that is where market manipulators, like the big banks and institutions, right? We are talking about FIIs and DIIs, the market manipulators who are, managing billions worth of capital. They are, manipulating because they do not have any lack of liquidity. They can inject the market with millions, hundreds of millions of dollars, and they can extract the market, with hundreds of millions of dollars as well. People like you and me, we do not have those kind of liquidity or capital to, shake the market. So but we should be aware of such, circumstances. We should be aware of such concepts, because they can help you in understanding that yes, there is a particular pivot level where prices are approaching, and at the back of your head, you are already aware that there could be a manipulation, and then, you could improvise your strategies based on these market manipulation strategies as well. So based on this current example, the prices had closed, were holding the resistance. They closed above, attracting the breakout traders. They reversed again, creating panic in the breakout traders, and then they created like a bullish candle, indicating that now it created a flip zone, correct? We talk a lot about flip zones, where if a resistance is taken out, it becomes a support, and vice versa. So with the green candle coming out, people thought that now the prices should continue, only for it to continue back below. So people are getting stopped out left and right? So breakout traders are getting stopped out, support resistance traders are getting stopped out. This is a clear example of market manipulation. All right. Now that we have covered with the two major, manipulation and stop loss hunting concepts, it is very important to understand certain key points when it comes to trading. Remember, trading is 80% psychology and 20% skills. All right. Let me repeat that again. Trading is 80% psychology and 20% skills. It doesn't take much effort in terms of taking trade. All you have to do is click the mouse button and your trade is placed. Unlike the olden days where you had to call a broker, you had to, let him know the amount of quantity of shares that you wanted to purchase, and then, confirm the trade order, and the broker would contact the opposing party, and they would have a transaction. Now everything is electronic, everything is modernized, so everything is taking place at a very quick pace, correct? So that is the reason we have to be aware of the concepts, but a lot of emphasis has to go on psychology, right? Understanding the overall concept of trading, as well as the key points that have to be kept in mind, especially when we are trading. So let us start with the first point. It is to understand the market before you start trading. Very crucial, because a lot of people, I have been observing that people enter the markets just to make money, right? Yes, money is very important in terms of financial markets. Yes, everyone comes with the aim of making money, but it is also important to understand that it is important to understand the foundation, the basis of that particular market before you start entering. It's like driving a car. If someone who's young cannot be given a car to drive, they have to learn in driving in a driving school. They have to pass the tests, the assessments, the practical tests, and then they are given the license, the authority to drive a vehicle, correct? So similarly, when it comes to the financial markets, it is very important to understand that you have to learn the basics, keep learning, keep updating yourself in terms of what the markets are. So let us have a quick example, illustration, right, in terms of what this particular key point is talking, such as market terminology, the unique traits of market, and the factors influencing. So the more factors, the more number of dots that you are able to connect, that is where you become wholesome, right? Wholesome in terms of taking educated trading decisions, right? Very important. The more information that you gather about a particular market, the more educated you are about a particular market, the more informed decisions you can make for that particular market, correct? Rather than taking trades blindly based on gut feeling, and then repenting later when losses kick in. So it is very important to understand the market's foundations, correct, before entering and taking trades in the market. And then we have determining determining market conditions. So when it comes to determining market conditions, there are majorly two major categories when it comes to the determination of market conditions. We have fundamental analysis and we have technical analysis, right? Now, yes, there is going to be a lot of tussle between fundamentalists and technical analysts, but please bear in mind, keep in mind that it is always to best to have the best of both worlds in terms of having good information, good understanding of the financial concepts, the fundamental concepts, right? We have the balance sheet, we have the profit and loss statement, we have cash flows, we have certain ratios such as PE ratio, EPS ratio, PB ratio, PE ratio. So there are many important and valuable concepts when it comes to fundamental analysis. And when you look at technical analysis, we have charts, we have patterns, we have candlesticks, we have structures, we have strategies which come under technical analysis. So if you can have uh, if you can have a good understanding of fundamental analysis and technical analysis, you can be much better informed. If the fundamental analysis are showing good and positive numbers, and the technical analysis are showing that yes, the prices are creating an higher highs and higher lows, the trend is basically bullish, that increases the probability of prices doing what you are expecting it to do. So that is exactly what you mean by informed trading decisions, right? If you're clear about fundamentals and if you're clear about technicals, you are basically having the best of both worlds. And once you combine the two, your analysis gets very, very clear, and you are having more a higher probability in terms of making money, in terms of achieving success, correct? So always keep in mind we need to connect the best of both worlds as well. And that is what exactly we are doing at Dolphin Markets too. I am more of a technical trader, so I'm talking more of, from a technical analysis point of view. We will have other analysts coming in soon who will be focusing on fundamental analysis, correct? So if you can get the best of both the worlds, right? The best of technical analysis and the best of fundamental analysis, that will be a great combination, right? Which will definitely lead to much higher success in the financial markets, especially in financial trading. Then we have assessing your risk appetite. Please bear in mind when it comes to financial trading, we always want to be clear in terms of how much we are willing to risk, right? A lot of people who come for our live streaming sessions are like, Harsh, you are recommending a hot stock, you are recommending a hot stock. Should we go all in? How many should we buy? Should we buy all? And to those people, I keep saying that please bear in mind the markets are based on probabilities. The markets do not run on certainties, correct? So since we are not certain, we should never risk, large amounts of capital. Always, like we always mention, based on even our hot stock recommendations, correct? Whenever a hot stock recommendation is provided, we inform you that enter based on a position size between 10 to 15. We do not say enter at 100% of your capital, right? Because we ourselves are not certain. No one is certain in terms of what the markets will do tomorrow, what the markets will do day after tomorrow, what the markets will do the next week. So that is the reason it is very important to focus on risk, correct? Because if you're focusing on risk, you are eventually conserving your capital, and that is the most important aspect when it comes to trading. Trading is not about just making money. That is important, I'm not denying, but more than that, it is important how you're managing your risk, right? How you are managing or conserving your account, because you need to be aware that trading is not what you call, trading is not hypothetical, trading is practical. In the hypothetical world, 1 plus 1 plus 1 is 3, but in the trading world, it basically goes as 1 plus 1 minus 1 plus 1 minus 1 plus 1 is equal to 3. So I hope you get the point. Trading will always have winners and losers, and based on this, overall, if you are having a net positive, a net profitable value, then you are very good to go. So always make sure to assess your risk. If you are a person who doesn't want to risk a lot, always focus on taking low risk, right? Maybe 1 or 2%. For people who are like, no, they have more you know um, inclusion, that, or they have more analysis to back up in terms of this stock will have higher probability of performing, they can go to with a medium risk appetite, such as maybe 5 to 20, right? And some people are way too optimistic, and they're like, this has to go, because of the fundamentals, because of the future perspectives, so on and so forth. So those people who are very keen on or very optimistic about a particular trade, they can go at at a much higher risk, maybe more than 20 or 30%, right? But please bear in mind, the more the risk, the more the profits, but the more the losses as well. So we want to be in a healthy balance where we are risking substantial, but not risking to the point where we are not able to sleep at night, right? Because then you are gambling, you are not trading. Then we have basically looking at the risk to reward ratio. How much are we able to risk in terms of how much are we able to, make in terms of profits? So the entire concept of risk to reward is, if I'm risking one, am I able to make two or three? If I'm able to consistently keep the structure of risking one to make three or to make two, over the long run, even if though I might be having bad days in terms of bad trading days, I will be still cumulatively net positive, right? And that is the entire game of risk to reward. The bigger the risk to reward ratio, the better, right? But as a general consensus, a risk to reward of 1 is to 3, where you risk 1 to make 3, right? For example, you risk 100 rupees to make a profit of 300 rupees. So that is equivalent to a risk to reward of 1 is to 3, right? Similarly, I mean, you can see the examples right in front of you. Risking $100 to make $100, we call that as a risk to reward as 1 is to 1. If you are risking 100 to make 300, that is a risk to reward of 1 is to 3. The greater the risk to reward, the better the trading strategy is, right? And the higher the probability of you to make more bigger profits, correct? Then we are looking at documenting your trading plan. Now, this is very vital yet overlooked by a lot of traders, including me. When I had started trading, when I was learning from some of the best people in the financial markets, I was, hammered with information, and I was instructed to maintain a checklist or a trading plan, right? But like all of us, since we are so addicted to the charts and we want to make money, we want to analyze the markets, I used to take this for granted, and it had affected me severely, right? So please learn from your mentor, that, and don't repeat the mistakes, right? So it is important to have a trading plan in your hand when you're analyzing the markets and when you're looking for trading opportunities, right? You need to know exactly what you are doing in the markets. Where do you plan to enter? Where do you plan to exit? Some people take it to the next level in terms of what emotions they are having in terms of placing the trade. Are they happy? Are they scared? Are they excited? Are they nervous? So there are a lot of checkpoints, and you can create a customizable trade plan according to your needs, right? We at Dolphin Markets are also maintaining, right? But we are very meticulous and structured when it comes to what level we are planning to enter, where is the entry price, what is the 5% profit level, and the date. So we are having a very clear plan for ourselves, right? Trade plan for ourselves. We are also informing people and maintaining a record as well in terms of once the price hits our target, we are mentioning sorry, we are mentioning and recording where our closing price is, where our take profit was, and what was the profit that was achieved. So this is a typical outline of a trading plan. The more information that you can add to a trading plan, the more better it can become, right? Because then you will be aware of all the nitty gritties, of all the subtleties that are required. So when people are right, having a clear trading plan in terms of, I will take a trade based on XYZ reasons. So the trading plan should be having a detailed discussion, a detailed description, sorry, of all the necessary information, correct, for the trade plan. How much I'm willing to risk, what is my risk appetite, where is my stop loss, what am I planning to do if price goes against me, what am I planning to do if price goes in my favor. So you are well prepared before you also place the trade. Many people, they are like, Harsh, we will see at it later, let us take the trade now and we will see what happens later. That is not the right way to think about trading, because trading is about probabilities, correct? Trading is not about certainties. And last but not the least, we would be talking about being emotionless. I know this is very hard. I'm having an experience in the markets of more than 8 years, but even till now, there are certain scenarios when the trades are maybe not favoring us, correct? The trades are going against us. They're not following our plan of, projection. But we are human beings, right? And we will have emotions, but it is important to cut out as much of emotions as possible, because trading is based on numbers and trading is based on probabilities, correct? So we are not going to be taking trades with that assurity that it has to do what we expect it to do. Remember, if you come with that mindset, if you come with that with that thought process, you are in the wrong markets, correct? The markets are subjective to movement, correct? The markets are dynamic, so the markets will do what they have to do. You and me as traders, as investors, can do the analysis, can figure out, can identify what possible trading opportunities are available. But please bear in mind that every trade is not in your every trade that you take is not in your control. They can only go in three directions: either in an upward movement, that is called bullish direction, either in a downward movement called bearish direction, or it can go sideways, correct, in a neutral direction. And we just need to be clear that Trading is a zero sum game. Trading runs on probabilities and not certainties. And whatever decisions we take, we need to keep emotions, because emotions play a huge factor when it comes to trading, correct? With emotions, when people get, for example, when a trade is going against a particular trader's entry point, they start to panic, they start to get angry, they start to get nervous, they start to get irritated. These are emotions that are coming out based on what the markets are showcasing, right? So for people who have been having experience, I'm pretty sure you all are aware that emotions will always surface to the will always come out, right? Will always be projected once you are in trading. But it is the hard work and the consistency that is required to make sure that yes, emotions are coming out, but we want to keep them away, because we want to be clear. If your fundamental analysis is correct, if your technical analysis is correct, if your risk to reward is correct, if your risk appetite is correct, and if your risk to reward is correct, and if you have a clear trading plan, you are having a lot of checklists that are already accomplished. So that also reduces the load of having emotions while trading. That is the reason why all these points are so important, are very vital to your success in the trading journey. So I hope people have been able to understand the importance of having a trade plan, the importance of being proficient in fundamentals and in technicals, and in assessing the risk appetite, and also understanding risk to reward, and most importantly, trading plan, right? I mean, for a pilot who flies a plane, when he is at the dock, before reversing to go onto the runway for taxiing and eventually flying, they have a checklist, right? A checklist is where they would be checking for each and every detail. If anything is missing in the checklist, the pilot is not allowed to fly. So similarly, when it comes to trading, it is very important before you take off, before you place a trade, it is very vital for you to have your own checklist in place to understand the parameters that you have written for yourself, maybe in terms of trend, in terms of support resistance, in terms of key pivot points, so on and so forth. So once you have a checklist and all the parameters are tick marked, then you can be certain that yes, my checklist is completed, and now I'm ready to take off, as in I'm ready to take trades. All right. So I hope everyone had a good learning. I'm pretty happy that I've been able to provide you with valuable information. We have been talking about market manipulation. We have been talking about stop loss hunting, and these can only be performed by the big banks and institutions. Here we're talking about the FIIs and the DIIs. People or companies such as Morgan Stanley, Deutsche Bank, these are FIIs, and such as ICICI Prudential, or mutual fund companies, they act as DIIs. So these are the people, these are the organizations that have a lot of money, that have a lot of capital with them, and they can manipulate the markets. So they are able to manipulate the markets in two ways. First, by the process of stop loss hunting, where a majority of people are stopped out only to continue back into the desired direction, right? As the one that I showcased. And second is market manipulation, where at certain key levels, where people, or where the majority of the consensus that people are having is that prices will be acting in a particular way, the prices are manipulated around those levels, and are skewed or distorted to create more confusion. And most importantly, the key points, right? Because like I had said, trading is 80% psychology and 20% skill. So very important to keep in mind of all the points that I have discussed today, right? I hope everyone has had a good time. Please be present for tomorrow's live streaming sessions. Since today the market has been closed, we will have a look at how the markets are performing tomorrow when the stock market opens, and any changes, any advancements, any updates in the markets and in our watch list. Sorry. we will let you know. All right. So please make sure to come back for tomorrow's first live streaming session. Tomorrow going to be the 21st of November, being a Thursday, and Thursdays are pretty interesting, right? Because as in how the days are flying, correct? Time flies. Remember, the markets are also improvising, and with Friday also coming in just after tomorrow, there can be some advancements in the stock market. So please stay tuned for the live streaming sessions tomorrow. We have live streaming sessions all the way from Monday till Friday, right? Monday, Tuesday, Wednesday, Thursday, Friday. And I, Harsh, will personally make sure to provide you with three live streaming sessions, right? Two live streaming sessions that take place when the market is running, and the third live streaming session that takes place after the stock market is closed, where we shift our focus from the stock market to technical analysis and also to forex, gold, and CFD markets, right? The international markets. All right, I hope everyone has had a very good understanding. I wish everyone a great evening. Hopefully, all of you are able to go back home and spend time with your loved and near and dear ones, and and pursuing other hobbies, other activities that you are interested in. Have a great evening, and I will see you tomorrow. So, until then, namaste and take care. Bye bye.